Welcome to the Beating the Market podcast. Beating the Market is a community on seeking alpha that empowers leaders of the investment world for today and tomorrow. We put institutional quality research and investment practices into your hands by identifying high quality businesses at reasonable prices.
Hello, everybody out there in the digital ether, the investing community. Welcome to the Beating the Market podcast. Today, we're here with Tyler Oakland. He is the foremost bull on the internet for a company called Opendoor. I believe that's an accurate characterization, Tyler.
I'm definitely the loudest.
Certainly the loudest. I think, I don't think that there's any institutions doing as much work analyzing this company. And we've been hugely inspired by the work that Tyler's done. We're incredibly grateful for the work he's done. We as well have long time been bulls. We showed up day one, basically, upon, Chamath's one pager. I think Pareto's principle, price is law. There's going to be 1 to 5% of anything that generates the majority of the returns, and out of Chamath's SPACs, this will probably, in our estimation, be a part of that 1 to 5%. So we're extremely excited to be here with Tyler today. We're also here today with Jared Simons, who's a lead research associate at Beating the Market, a part of the team that I work on. So if you, I guess we'll start with you, Tyler. If you could introduce yourself, just tell the world, whatever you'd like to share. I know you're just, we've been chatting for the past 5 to 10 minutes, maybe a little bit longer. And you're just a very interesting person with a deep background and past that I think it brings a lot of value to the investing community. So anything you'd like to share about yourself, and, feel free to introduce yourself.
Sure. Yeah. Thank you, Lewis and Jared, for having me. I'm Tyler Oakland. I have an unusual background, I guess. I'm a physician and surgeon at Stanford Hospital, completing my final year of training for head and neck surgery, which, like I said, is a little unusual, but I'm passionate about business, particularly disruptive growth technology companies. I started looking more deeply into those types of companies last June, which is when I started writing about stocks for the first time. And it's been wild to have these opportunities to just talk finance with people.
That's awesome. And Jared, if you'd like to introduce yourself just quickly, and we'll get back into Tyler's.
Yeah, I'm Jared. I'm fintech analyst at Beating the Market, and super excited to be sharing our research and thoughts on Opendoor, as well as SoFi and Galileo, this podcast, and hear Tyler's takes.
Yeah, and I think, coming back to Tyler, I think both of your introductions have really noteworthy components to them. For you, Tyler, to have an unorthodox background, you go out there into the hedge fund universe, and lots of hedge funds, I think Dan Loeb of Third Point, he manages like 18 billion. He was writing on Twitter, like, we don't necessarily look for MBAs. We look for very unorthodox people. Did you win a championship in baseball? Were you, did you play 3 years in the Canadian Football League? I think unorthodox backgrounds create very interesting perspectives. And there's an orthodoxy of finance out there that, in my estimation, it homogenizes the financial community so that everybody has an equal outcome. It's almost like Western Europe Catholic feudalism in terms of, like, there is a structure and you live by that structure, and you will get your 150K as a 26-year-old VP, equity research associate, whatever, and then you'll get then you'll be the managing director at 32, but just don't step outside of the boundaries. So I think a lot of hedge funds, a lot of institutions that are looking for outperformance, looking for alpha, select very interesting people out there. So that's why among many reasons why we're very excited to sit down with you today. And to Jared, your point, yeah, I think Opendoor is a fintech play, and maybe we can start there. I guess, well, let's start with just a general pitch, and then we'll get into the embedded finance component of it, I'm sure, at some point throughout this session together, podcast, video podcast, whatever you like to call it. But Tyler, could you just pitch everybody just, maybe a 3x5 note card, why you believe Opendoor is going to consume market share within the traditional real estate industry?
Yeah, for sure. So from the top, basically, for those who aren't aware of Opendoor, the concept is pretty simple, but it's bold. It's that we can buy and sell a home online. And so it basically removes all the middleman in the real estate transaction. So realtors, mortgage brokers, title and escrow lawyers, all these different members of that stack are removed, and Opendoor internalizes all that complexity and provides a simple opportunity for home buyers and home sellers. I think for me, when I think about why Opendoor is going to take market share, actually goes back to a recent tweet that I responded to on Twitter, which, Jared, I think you know this. It was just a question asking, why do you think Opendoor is going to take market share? What gives you comfort that this is going to happen? And I think that brought 2 points to mind for me. So the first one is how misunderstood Opendoor is, right? The fact that that person was asking that question, why do you think this service is even going to exist, just harkens back to the underlying aspect of how Opendoor is misunderstood. It's like Opendoor is so misunderstood that people don't even think that this business will survive. They don't even think it's a product that people want, which is sort of fascinating. But then it made me have to reflect internally on why I believe in the Opendoor thesis. And that's where you start looking at the metrics, right? Like not the vanity metrics, but the actual actionable metrics, which are things like net promoter score, revenue growth, customer acquisition. And all those things for Opendoor are just hitting the inflection point on this massive hockey stick in the biggest asset class in the world. And so I think Opendoor, the thing that Opendoor is doing better than just about anyone outside of operational execution is just an obsession over the customer and the problem space. And time again, they've really demonstrated that they're not trying to maximize short-term profitability. They're really focused on being in service of the customer. And that's one of the reasons that I've been excited to cheer them on from the sidelines and follow their company.
Yeah, I think it's an extremely important component of it. And before you concluded that train of thought or that line of thinking, the thought that popped into my head was, it comes down to customer obsession. It comes down to, why are we doing this? And if you can, and we always talk about it at Beating the Market, if you can obsess over your customer to the extent that you charge them $500 and give them $5,000 of value, it's we call it immutable laws. It's a universal principle that's going to begin to take market share. On that subject, and you touched on it a little bit, they're internalizing, they're digitizing and making it and streamlining the entire stack, the entire real estate stack, which is throughout the transaction, there's constant back and forth between the lender, the realtor, the buying agent, the selling agent, title and escrow. Can you discuss how exactly does the streamlining look, and then what components, and then then there's inspections, appraisals. What components are kind of the sticking points? Because I think attaching mortgages, attaching escrow and title, that's Opendoor has really collapsed that. I think that has been where they pushed very hard and just made that very simple. What components of the process are still challenging for Opendoor in your eyes? What are kind of the last last hurdles that they overcome that create the truly 10x better experience?
So great question. I think for me, what really helped is the divide between the seller ecosystem and the buyer ecosystem. And when people talk about the real estate transaction, it's hard to actually keep those separate. It's like calling a book fiction or nonfiction. It's like they somehow mean the same thing, and it's because they're two sides of the same coin. But Opendoor's original product, like what got them to this size, is their 10x, arguably even better than that, experience in the seller ecosystem. And the reason for that is because the seller ecosystem is actually what's historically so poor. The buyer experience is actually a lot of times a little bit better, but it comes with a decent amount of issues as well. But if you just look at like the relative comparison of how much people hate selling a home relative to buying a home, buying is sort of exciting, right? Like it's like house hunting, or it's something that people enjoy doing. That's why Zillow has so much attention. It's not about selling their home. It's about people browsing for their dream home. And that's a very, very American thing. So the buying ecosystem is not where Opendoor has spent much of its time, but that's where I'm watching for them in the future. To touch on the seller ecosystem, right? Like the things that they've optimized in the seller ecosystem, I like the word you use, collapse. It's like they're a digital accordion of all the complexity of the seller experience. Because when you're selling a home, let's see, the traditional experience metrics are like 90 days to sell your home. So it's just sitting on the market. You have to clean it constantly. You have to stage it. You have to show it. You have to interact with realtors. You have to field offers. And then, some of those offers go away. And even after those 90 days, 10 to 20% fall through. So it's just a miserable experience that people have rated as the third most stressful in their life after a relative passing away or a divorce. I think that kind of says it all. And if I were a real estate tech company, that would be the transaction I'd be starting on. But for the buyer ecosystem, there are still some things that need to be fixed. So for example, like if I'm buying a home and I'm also a homeowner, I need that equity immediately. And so that's why power buyer products like Opendoor backed offers are so useful. You can avoid double mortgages, double moves, and the idea that if a home is appraised for less than the offer is, you don't have to come up with extra cash. Opendoor will just lower the offer. These are all like little things that reduce the inertia and the friction of the home buying experience and make it more delightful.
It's interesting. So Jared, you recently created a note entitled "Hit a Home Run with Opendoor." We invite everybody to check that out. Did you have any specific questions upon creating that note? Any insights or questions for Tyler today?
Yeah, I mean, as I was writing that note, I really recognized the power of this marketplace flywheel. And that was, as I was writing the note, it was clearly evident that there's a lot that's going on here with Opendoor, and it's a lot deeper because Opendoor is really all about the transaction. It's a transaction business, which is why as a fintech analyst, it's really been an interesting component, because at the end of the day, there's so many different components that go on in a real estate transaction. And a lot of that takes place over 90 days. And like people don't even care about the little things, about getting the paperwork digitized. And there's so many aspects that Opendoor will be able to add on potentially. So Tyler, how do you think about Opendoor growing its scale? And I think that, that's one of the really only risk that I see. It's not really if Opendoor will be successful or not. It's will Opendoor grow to the scale it needs so that it can offer these other services, value-added services to the transaction. So what do you think about them growing at scale?
Yeah, I think one of the core assumptions of Opendoor's model is that if we have enough money or if we have enough scale, we can solve problems that were prior impossible to solve, right? Like Opendoor is trying to solve a bunch of problems that it can only actually be both profitable, be a successful business, and solve as a much larger company. And so if you actually start looking at the market dynamics of where they're growing and what their market share is, they gave their original investor presentation where they said they're going to have 4% market share, which corresponds to 50 billion. Just to add some extra color to that, like home prices have appreciated dramatically from that original investor presentation. So you'd actually be looking more at like 65 billion for a 4% market share. But they're not going for 4% market share at all, especially with Zillow out of the picture. OfferPad being a very distant competitor alongside the likes of Redfin, at least today. They're about 12 to 15% market share in their biggest markets and growing rapidly. I see no reason why they're not able to achieve, as a composite percentage across the United States, more like a quarter of transactions. I think that pathway takes years and it's down the road. But if you can have that scale, if you've got a quarter of a $2.5 trillion market, you can do things that no one else can. And the reason that this is important, and I've been really inspired lately reading the Jeff Bezos shareholder letters. I think I shared it in our group, but he had the one where he talks about when Amazon reached 100 billion in revenue. And then he also linked to the original 1997 shareholder letter. And they're remarkably similar in terms of clarity of vision and what Amazon needs to be to achieve those milestones. And I think Opendoor is a lot of the same way. If they can be customer obsessed, if they can achieve the scale that I know internally they're setting their sights on, I don't expect moving to cost 5%. I expect it to be a fraction of that. And that's just customer acquisition cost for all of the ancillary services, those embedded finance opportunities that you're talking about, those fintech opportunities to really materialize in a dramatic way.
I think the take rate's really interesting. I think, we've studied the take rate, and, I want to, as an aside, I want to get some bearish theses out there. Like I want to throw you some pitches here that, you can swing at in terms of what are the common bearish theses. But, to segue from what you just said, I think analyzing the take rate from 2014, when they were buying their original homes, when they went out to like the original 10 people and said, hey, if you want to move in 24 hours, we'll give you 85% of price per square foot, average price per square foot in the neighborhood. We'll give you 85%. Will you do that? You can close on this transaction in 24 hours, no hassle, no sweat, no selling agent. It's immediate convenience for money, a proven business model since the dawn of man. You're going to pay, dollars for convenience. And I think Uber went through this same experience. Remember, we heard about all the Uber drivers. Drive for Uber, you make 150K a year, right? Like that was the initial value proposition, because it was true. Like the convenience was so exceptional that, Uber today is not free cash flow positive. So for everybody out there,
Well,
they are in like a duopoly. But can you comment on the evolution of the take rate? Because you touched on it at the very end there, at the very end of your insights there. But the evolution of the take rate has been such that it started at 10 to 15% of comps, average price per square foot in a neighborhood, targeting what, a commoditized, relatively speaking, neighborhood. It started at 10 to 15% of comps. It's evolved to 5%, which is, arguably better than the traditional. I think it varies. It depends on, a certain factors, but it can be now better and economically than the traditional real estate transaction. Can you comment on your insights, your observations? What does it mean that their take rate has collapsed so precipitously, and what does the future look like from that vantage point?
Yeah. So part of the reason I kind of linked back to Amazon is not just the similarities kind of in the atoms and bits of Amazon, right? Like hard assets and software, very similar to Opendoor. There's very few companies that are doing that, but also that Opendoor CEO, Eric Wu, his favorite entrepreneur, and like his entrepreneur muse, is Jeff Bezos, because he did it the way he wanted to. He built his company the way he wanted to. He patiently executed. And I think that's really important when you, like, for me, for example, I don't have access to a lot of different financial tools. So I have to piece the story and the strategy together myself from a lot of different data. And so it's helpful for me to know the psychology of the person who's leading the company. And so for Eric Wu, looking into Jeff Bezos, 1997, or sorry, his most recent shareholder letter, he said, we wanted to make Prime such a good value that you'd be irresponsible not to have it, right? Which is such a compelling point for a business owner and leader to make about their product. To create a product, like you said, where the customer is getting $5,000 of value, but you're charging only 500, right? It'd be fiscally irresponsible for you to not use this option. And I think that's the crux here, right? Because you can have a great product, great distribution. Look at Zillow, great product, great distribution, decent leadership. But if you're not able to make that leap where the value is so much so that a consumer would be crazy to not use it, it's really hard to find that product market fit that Opendoor has. And so they created a 10x better product in terms of experience. But then over the past year, they've been able to lower the price to where it's 5%, right? Realtor is traditionally 6%. So it's even cheaper than the realtor experience. And so on the one hand, it makes their value proposition go like this. And that's why they had to revise up their estimate so much, I think, because they realized their seller conversion went from like 25 to 30% to over 50%. It was well beyond their own capacity. But the other thing strategically that's important to know is if you've got an 80% margin business, everyone can compete, right? Like, it doesn't matter if you shave off a few percentage points here and there. I mean, shareholders might appreciate it, but it's not going to win you any competitive edge over your peers. In the case of Opendoor, where iBuying is a 5 to 10% margin business at best, if they can actually lower the price to 5% and they've got the lowest cost of capital, the best scale, the best economies of scale, they can make the most charging the least amount of money, competitors lose. And that's what we saw with Zillow, is the best funded, most iconic real estate technology company in the world, took a big swing, billions of dollars in 3 years and a new CEO, and they weren't able to compete. It was too challenging. And so that pricing dynamic is really critical for Opendoor strategy in a lot of ways.
Yeah, I really appreciated the idea of it almost being irresponsible to not own Prime. Somewhat tangentially related, I've been characterizing Opendoor in this way. It's almost irresponsible at this point not to put 1% of assets under management. You go and you look out into the investing world, and you have plenty of 80% margin companies trading at 50 to 100 times sales, and investors are eating it up because there's safety. They feel safe owning it. But the greatest stocks of the last 50 years, Walmart, razors thin retail margins, huge executional lift, but because it was so challenging, no competitors ever really showed up. Target, Amazon, they've shown up, but in the process, Walmart built a $500 billion business from $6 billion and $5 billion in 1973 to $600 billion today. The share price has gone up more than even that $5 billion to $600 billion in market cap. Share price has gone up more due to buybacks. So it's been an even greater, return. Lowe's, Home Depot, these have been generational wealth building companies. Amazon, right? Even Apple traded at 9 times, 10 times price to earnings in 2010, 2011, because people were so burned on Nokia, BlackBerry, all these hardware providers, these commodity hardware providers, that they wouldn't go anywhere near something like it. But today you see out in the market, people are willing to pay 50 times sales for an 80% gross margin company that is just attracting competitors like flies on what. Like it's just, the competitors are just flocking in. So it's like, to my point, it's almost irresponsible not to allocate something to Opendoor. We're overweight Opendoor, but something. You look, what other company out there is growing from 0 in revenue to 5 billion in revenue, 2014, 2019, and then scaling at this incredible rate. So my question on the point of scaling, what is your perception around, because you recently released estimates for 2022, and coincidentally you said $22 billion in revenue, which I think for the person just being introduced to Opendoor, that might sound exceptional, but personally I think it's well within the realm of possibilities.
Yeah.
Could you comment on what are the assumptions, what are your thoughts on the housing market, interest rates, all of the assumptions going into an estimate for 2022, $22 billion in revenue?
Yeah, so part of what I did to get to that number was I started just by making Q4 revenue estimates as a run rate for 2022. So they guided for about 3.2 billion. So I just multiplied that by 4. And I was like, okay, so we're looking at close to $13 billion run rate. And that's assuming the company doesn't grow at all, right? If they just continue to sell the same number of homes that they did in Q4, even though Q4 is seasonally the worst, quarter of the year for selling real estate, right? People don't want to sell their homes during Christmas or Hanukkah or whatever, or Thanksgiving. They just want to be like at the actual home. So I felt like a good floor was 13 billion. But then, you start looking into the fact that, Opendoor launched 23 markets in 2021 off of a base of 21 markets. So they more than doubled market footprint. And those markets haven't even begun to really take any degree of scale. But if you look at their investor presentation, it's at that 10 to 12 months that inflection point really happens. And so I was able to kind of say, I don't think we're going to get to double from all those markets, but I think that they're going to contribute materially. Also, I think that they're going to continue to gain market share in their core markets, because if you look at their quarterly customer acquisition, homes sold, homes acquired, all those metrics are improving on a quarterly, like a compound quarterly growth rate, triple digits in a lot of cases. And so, that's part of the reason why you can see that the value proposition is clearly resonating with consumers, right? Like they're still subscale. They're still, you know what I mean? Like even though they're going to be reporting close to $8 billion in sales in 2021, they're still very, very early on their pathway to actually achieving scale in the United States. And so, I think 22 billion is actually super conservative, to be totally honest with you guys. I constantly provide estimates for Opendoor, and I've always been wrong, but in the low direction. And I think that's important, right? Especially for the position that I'm occupying as an Opendoor bull. I don't want to be like a hype person giving people false information, but I also don't want to be like, the regular internet analysts who are saying that Opendoor is only going to achieve 15 billion in sales. I think that that's wonky math. There's also a lot of macro conditions like rising mortgage rates and rising interest rates. I don't see that materially affecting a company that only has 0.3% market share with incandescent product market fit, growing 14x over the past 4 quarters.
Yeah, I think that's a very important point about this style of investing. We call it inverse bubbles, innovation, disruption, whatever. But I think inverse bubbles is an important idea because there's this bubble of capital out there, which is, all of the that stack, kind of not rent seeking. They're all working hard, but relative to an Opendoor product, it's almost like rent seeking in terms of, the cost of their services, title, escrow, buying agent, selling agent, the whole stack relative to the value of Opendoor's product. But I think it's the good thing about investing in this way is that irrespective of kind of what the general market is doing, these companies with a 10x better product can continue to consume market share. So it's almost irrelevant to us. But I think the bears would say, okay, Opendoor bought a bunch of inventory. They have 15,000 homes and the market's gone soft. The market's gone soft. Could you rebut or give your take on what 15,000 homes means? And you use the word composite at one point, which I think is relevant and interesting. But what does 15,000 homes mean purchased in 2021 if the market goes soft in 2022?
So I spoke earlier about Opendoor being subscale, and I think that's backed up by the numbers that we see in inventory, right? Like they're continuing to scale into their inventory, and ideally we'd see them kind of selling homes as rapidly as they're buying homes. I think that would make investors feel a little bit more comforted and encouraged, because then we would also be able to start seeing some free cash flow generation. But what's clearly happening is that Opendoor is saying, no, we're not at the scale that we want to be yet. And so that's why they're buying homes so quickly. It's complicated a little bit by seasonal factors, right? Like homes just sell more slowly in Q4. And in Q3, Opendoor and Zillow both overbought homes in a mad dash to just accumulate as many homes as possible. Opendoor just did it with better economics. But I think behind closed doors, they were like, we probably bought too many homes. Like that, I think that's fair to say. We probably bought more homes than we needed, especially going into Q4, because their holding times actually are now in the 110 to 120 day range, which is a little bit above what they want it to be. The counter argument to that is, maybe they felt like HPA would be stronger in the early months of 2022, and it wouldn't be a big deal to just layer into extra inventory, even if it added on to their holding periods. Yeah, but I think that's kind of the idea. It's just that like they are going to need to continue scaling into inventory, which means inventory will always be high, because it's they have to have the inventory to make their revenue, right? And so they're going to have a better sense on market dynamics, HPA in the future than just about anyone, I think, at this point. And so that's going to influence their holding periods and how much inventory they have.
Yeah, I think one of the important ideas that I've kind of ascertained from the messaging from management and just generally understanding what's going on out there, especially, I live in the 5th fastest growing county in the United States. So I can see how, price per square foot as a composite of my region is likely vastly different than, a suburb of New York City right now, where somebody had to work in Manhattan, but now there's an exodus. Well, the suburbs, everybody in the suburbs are doing well. But my point is that every market is a portfolio. Every Zillow, certainly not Zillow. Opendoor is going into Phoenix or Jacksonville, Florida, or Boston or San Diego. And there are going to be very unique pricing dynamics for every single one. So I've been seeing the Phoenix data, and Phoenix is, obviously a notoriously, it was the poster child for 2008, 2009, which maybe you can comment on that and how it relates to Opendoor. But, it was the poster child for, volatility. We've seen the data from Phoenix that it's less than desirable. I think that was like kind of the quintessential Zillow botched this. They overpaid. It just didn't work, and they had to back out. But there's home price appreciation in Florida, which had the most net adds of any state, or even my county, which is the 5th fastest growing county. I think the home pricing dynamics are going to be vastly different here than they would be in Phoenix. And Opendoor is and this is, it's, I know you find it entertaining, but bears will go through the MLS of a particular region and say, hey, look what they paid and look what they're selling it for. They're, the margins, the gross margin here is the spread is -8%. This doesn't work, right? But we're not looking for perfection across all regions, across all homes. We're looking for a composite spread capture, which translates to gross margin, which translates to contribution margin, which is variable expenses less revenue, that's your contribution margin, which then flows into free cash flow, ultimately the profit we receive. So what's your take on the varying regions, the expanding portfolio, and how that's gone for Opendoor?
Yeah, great question. And just to double tap what you just said about like spot checking gross profit margins for particular homes, I would be very suspicious as a customer of Opendoor if they made HPA on every home sale, right? Like that's probably not a good customer value proposition if every home that Opendoor bought and sold had positive HPA. As a shareholder, I'd like that to be positive as a composite, but it's data science, right? It's a bell curve. It's not like they're not pricing every home with a specified amount of HPA. They're a transaction company, they're a payment company. So they're going to lose some HPA, but on the whole, they're going to try to be HPA positive, but make most of their money in fees and ancillary services. And then thinking about, I like the word portfolio to think about Opendoor's opportunities expands into these 44 markets. They have an increasing data advantage, right, when it comes to pricing homes. But their data advantage is also beginning to extend into being a proxy for where residential real estate prices are heading in the United States over a short period of time, over like a 45 to 60-day period of time. That's what their data can actually tell them. And so the reason that this comes in handy is, like you said, real estate is local. Every market is different. Every market is going to behave differently. Some markets in 2008 cratered. Some markets actually did fine. And so if you have a portfolio of markets that you're managing and you have a data advantage like Opendoor does, you know where to put your foot on the gas and where to take your foot off the gas. You know where to leverage into markets that are going to be doing better and where to stop purchasing homes in markets that you think are going to do worse. And that's an opportunity, as we just bring this all back to where we started this conversation, that is an opportunity that only a massive business can enjoy. And that's why Opendoor achieving scale is so important, because once they have that scale, it's not just that they have all these embedded finance opportunities, but they also de-risk themselves. They make residential real estate much more of a predictable source of revenue and income.
Yeah, as you're saying it, I'm just thinking, how excited must everybody at Opendoor be? This is arguably the most significant lift technologically, cognitively of the 2020s, potentially of the 21st century. If you can datify, as we've been calling it, where we talk a lot about the consumer credit ecosystem, the datification there, which we think is kind of one of those last bastions of, this was too hard for Web 2 to do. They could put everybody's, thoughts about, whoever's getting elected to the, they could put all of those thoughts on the internet. They could put a book on the internet, but to revolutionize these very challenging, very commoditized, just messy, there's constantly a crisis. There's a real estate crisis. There's a credit crisis. There's always these issues. But if we can finally take cloud deployed AI and machine learning, which is at the heart of Opendoor, and I think it's noteworthy, people, why now? Why could Opendoor do this now? Well, GPU based parallel processing in the cloud at an affordable price it still doesn't really exist in the way that it will, but it certainly didn't exist 10 years ago or 15 years ago when Max and Keith, PayPal, Max Levchin and Keith Rabois co-founded Opendoor. It certainly didn't exist when they originally kind of had an inkling of this idea, and then came across Eric Wu later on in life, who, it was kind of the, he created the concept of Opendoor. I think it's very interesting. Something that my mind keeps coming back to, and what I've really found interesting about this Opendoor story, is that I know I've mentioned it already, but I think it's so important, and it's so relevant to what we're experiencing now. And that is that in 2015 or 2014, but I would say it was probably closer to 2015. They went to those original 10 people, and they said, we'll give you 85% of comps, average price per square foot in the neighborhood, if you sell your house to us in 24 hours. And there's this convenience fee. You know, you're exchanging money for convenience. They scaled they could create a $50 billion business doing that. In my opinion, I think they would capture over time 10% of the entire market share. Just fat pitch, easy. You want to get out of this house in 24 hours, we'll give you that. Because I've met people that say, you know, I want out of this house this week. I don't want to deal with a selling agent. I don't want to deal with staging. I don't want to deal with refurbishments. I don't want to deal with cleaning it. I want out right now. I met somebody that did 80% of comps. They just said, and it wasn't to Opendoor, it was just to some random person. They said, I want out now. I'll give you this at a massive discount. And the person was almost in disbelief as an aside. So it's fine for, I think, a lot of people to not believe that that's possible. But my thing is, I think you could capture 10% of the entire real estate market using this fat pitch model. And I think OfferPad is using this fat pitch model. I think Redfin might try to use the fat pitch model, but Opendoor did that for, you know, a few years, gradually compressed their take rate to the point today where it's 5%, where it's extraordinarily competitive, if not better than the traditional model. I just think that it's noteworthy that they have said, hey, we could do this business model at a big scale using the fat pitch model, the bigger take rate, the convenience model. But we feel so confident in this AI machine learning that you just described for everybody, that we're going to compress the take rate to 5%. And eventually we believe that the take rate is going to go to 0%. So could you illustrate for everybody, you know, because I think this vanquishes the bear theses also, but could you illustrate for everybody, what's the psychology? And I think you did to an extent already, but what's the psychology behind taking that take rate from only fat pitches 15% down to 5%, down to potentially 0%? And where's the free cash flow at potentially 0%?
Yeah, I think, you know, historically, especially early in Opendoor's life cycle, Eric Wu talked about taking the commission down to 0%. And then he kind of backtracked a few times afterwards, being like, maybe not 0%, but lower. And I think that'll be especially, like, I have much more conviction that will continue to happen in higher priced homes. Because once you get into the $1 million, $2 million homes, people aren't going to be giving out 6% of that home's value, I think, to a company like Opendoor, but it would still be very profitable at a 3% margin, for example, as long as they're accurate. But the psychology of compressing prices, I don't think has anything to do with competition, right? Opendoor is customer obsessed and competition aware. So they're always going to be monitoring to see if there's any you know, products that other companies in the space are offering that might be offering a better value to customers. But they're not lowering prices as some sort of competitive lever against other companies. I think it all goes back to the actual customer. I think the psychology there is, we want to improve mobility of our entire country. We want people to be able to move with a tap of a button, and for it not to be such a horrible, stressful experience. People should be empowered by the biggest asset class in the world and by their biggest purchase. And historically, that's not been the case. It's been super stressful and painful. But I think Opendoor, in the service of the consumer, is continuing to lower that fee just because they want to make it easier to transact. They want to make it easier for people to move, and it powers their flywheel too, right? Like I said, scale is critical for the type of business they're pursuing, and all of that feeds back into the flywheel. So if they lower fees to consumers, more transactions happen, right? And more transactions mean more ancillary services, more selection for customers. All of that powers this massive flywheel, that's orbiting around Opendoor potentially as it scales into the company I think it's going to become.
Yeah, I think that you described Opendoor's growth engine really well, of how they buy and sell real estate, and how they have been expanding from 21 markets to 44 markets. And as they grow, they de-risk because they have exposure to different markets. So that's like the number one strategy and the number one wedge, and that's their real growth engine. But the high margin opportunities, the value added services, whether title and escrow, mortgages, third party businesses, I mean, that's what really is, I think, what's most exciting about Opendoor. And those high margin services, they are what enable Opendoor to lower the transaction fees of real estate. So I think that's, I mean, the way that you describe the growth engine and the way that we understand that is what it makes it so exciting when we think about these high margin opportunities. And that's where we really get the Amazon comparison, because Amazon would bring advertisers, use advertisements to lower its revenues and lower its fees. And then they aggregated the supply, and then everybody else wanted to follow the supply, and that created demand. So if Opendoor can do this, I mean, it's extremely exciting.
Yeah, I think that's a great point. It kind of brings up like one of the things I'm most excited about, if not most excited about for Opendoor, is like, to invest in Opendoor today, you have to be able to suspend judgment a little bit and not think too rigidly about like what it's doing in this moment. And I think to be a good investor in technology, you have to have that same mindset, right? You have to have a little bit of that science fiction interest, to be able to be like, okay, how can this company look in the future, and how would that benefit them strategically? But one of the questions or topics that I posed to our iBuying thread group earlier today was, when Opendoor does begin to add on those ancillary services, like when it does be able to offer things like moving or landscaping or like home renovations, how is it going to do that fundamentally? Is it going to be a marketplace where non-Opendoor employees can be matched to customers, i.e. like Fiverr or Upstart or Setter or Thumbtack in prop tech? Or is it going to internalize all of those products and bring them in-house so that it has complete control over that transaction? It's able to monitor for the actual quality of the service, but also make all of the revenue and the profits. And I think going back to that Amazon comparison, it's pretty clear which path they're going to take. I don't think they're trying to be like a handyman marketplace service. I think that they want to own the full stack. And again, that is only possible if you are a massively scaled business. And so that's what's great, right? Like, I've always likened the iBuying concept to the growth engine of the company, right? Like, that's what drives growth, is improving this incredible value proposition, right? Like, that's what Amazon Prime is, this incredible value proposition. You'd almost be irresponsible not to take, to just have a 10x better experience selling your home, but then to use that as a funnel to gain scale and own the transaction so that you can build out all of these more profitable services to add onto the engine, and really just automate and optimize the entire real estate transaction stack.
Yeah, I mean, I think that that's a great point, and it's almost like the Amazon where they optimize it internally, they figure it out, Opendoor figures it out, and once they figure it out and attract more supply, then they can attract third parties, and then it becomes the ultimate flywheel, and it ultimately just betters the customer experience.
Yeah, agreed.
I think I think we've covered a lot of the seller side of the experience. I want to just bring to everybody's attention listening that the Opendoor app is, the honest word that comes to my brain is sexy. Like, and it's evolved rapidly over the last 12 months. Like 12 months ago, or 15, 16 months ago, I was in the app and I was like, it's pretty good, but it's just kind of a Zillow or Realtor.com knockoff, which of course Opendoor does not compete with those companies in literally any sense, especially at this point. But I've been using the app and it's just gorgeous. Like, and when, I think, you go to Stripe's website and it's the most beautiful fintech website in the world. And then you talk to Stripe employees and they're all obsessed with the company and everybody wants to work at Stripe. It's the greatest thing since sliced bread. I think these UX UI kind of outward manifestations often reflect kind of what's going on behind closed doors. Not always, of course, but you go to the Opendoor app, it's very evident that whoever's creating it really believes in what they're doing. And the app is an absolute joy to use. It's beautiful, it's streamlined, it's gotten dramatically better in just 12 months. Have you been messing around with the app, or do you have any takes on, I think this also relates to what Jared said in terms of Opendoor starts as a supply aggregator, and then the buy element comes in at a later date, and then it becomes a marketplace, and then network effects really take hold in terms of the moat. But have you been messing around with the app at all, or any take there?
Yeah, I spend a decent amount of time on the app. When Opendoor allowed it, the app used to have all the markets that they're in at the bottom of the app, and I used to count the number of markets, like, I don't know, not every day, but maybe every other day, to see if they were launched in any new markets, because they would show up on the app before they would show up, like before they'd announce it. So I thought that was kind of cool. But I enjoy the app. I think going back to your point about, like, whoever's designing it believes in the company. Yes, I totally agree. I totally agree with that sentiment for Opendoor. And it's not just because I've had the opportunity to chat with a lot of Opendoor employees over the past 6 months, sort of about their experience with the company, but also because it's fundamental to their business, right? Like, they have the lowest cost structure of all technology companies that I'm aware of, especially rapidly growing ones, but particularly in the iBuying space, because they must have a culture of frugality in their company. They can't be paying employees $500K a year to write code. And so they're not able to compete with offers from Facebook or Google or big tech to hire these people. And so consequently, the employees at Opendoor are not mercenaries, they're missionaries, right? They're people that truly believe in the problem space and what the company is accomplishing. And they feel like they're actually making a difference for the better. And that's what's great about the company, is it manifests not just in product design, but also in things that you consider very mathematical and separate from philosophy, like data science. But there was an interview with Opendoor's head of data science maybe a few months ago, where he's like, I feel like I'm close to God when I'm solving this problem. You know what I mean? Which, to each their own, but at the end of the day, I think it's really compelling to think about the fact that Opendoor has the lowest cost structure. And so all employees had to come into that space because they were obsessed with the problem and because they believe in doing it in the service of the consumer. And that's the culture that they have, which is a huge competitive advantage, but it also manifests as a workforce of people who really love what they're doing.
Yeah, I think it's so essential to kind of understand this component. I say to beating the market's assets under management is cultural. Like, we invest in metrics, and the metrics are important. And some people, with our Facebook investment, may disagree with us. I actually think Zuckerberg's an all right guy, but I think that we first and foremost invest in culture. We are targeting founder-led, mission-driven companies with grit and operation, that are cultivating operators, that are cultivating the next set of founders that will build that company and then go off and create new companies, just like Jeff Lawson came out of Amazon's culture and created Twilio, which is just such an important company in terms of communications infrastructure globally. So I think that especially for those listening, I think what Tyler just shared is arguably the most important component of Opendoor. And it really comes back to the idea that, you have 100% of assets under management, right? You only need one stock to do well. Literally, you could divide it into 100, 100 stocks, 1% in each, right? You only need one company to resoundingly succeed, a la Walmart from 72 to 92, Lowe's from 82 to 2002, Home Depot also, Amazon from 92, founded in 93, but for alliteration purposes, 92 to 2022. You only need one, right? And this is such a special company. It's such a special company. They are tackling arguably the hardest problem of the 2020s, arguably of the 21st century, arguably of mankind's history. They're tackling, because mortgage originations on the Opendoor platform are going to be very challenging, right? We just printed, and I get into this rant all the time. We just printed tons of money, nearly $1 trillion to purchase mortgage-backed securities, because we have proven decade after decade, and Ahan was telling us that 51% of mortgages out there are ARM mortgages, which is what got people into trouble as rates got hiked 17 times from 2004-5 to 2007, and that precipitated the subprime crisis. But I think I'm convinced that this is the hardest problem of the 21st century, because Opendoor does overlap very heavily with the credit component of it. I've mentioned to you in the past that Opendoor is building financial products in Blend's computing environment. They've also made acquisitions. So, maybe I think Red Door is a mortgage technology company, correct?
Correct.
So, I don't know what direction they'll take that, but Blend is, a mortgage technology company. Red Door is a mortgage technology company. And I think ultimately Opendoor will be a mortgage technology company very significantly. So they are making this, for those that have seen the movie, I'm not sure if you guys have seen it, but A Wonderful Life was set in the 30s. We're still doing, I'm sorry to get excited about it, but I mean, we're still doing the same thing to this day. 100 years later, we're doing the same thing. There's a run on the banks, but this time there's no run on the banks. We just print money and destroy the middle class and make it harder for the people that are buying the homes and not paying the mortgages to actually buy the homes in the first place. So the system is so unbelievably broken. And maybe that's a glass half full perspective, but when you watch a movie from the 1930s with Jimmy Stewart, and 100 years later, the same story is playing out, there's gotta be a better way. Mankind's been around for only 15,000 years. Hopefully, with Elon Musk's help, we'll be around for 1 million years. So we're very early on. I don't think it's beyond, any stretch of the imagination that we can create something marginally better than what's been going on, as illustrated in A Wonderful Life. So, with these ideas, I think it's just take a bet on Opendoor. And if it's successful, that's the only investment you'll ever need, truly, in my opinion. If it's not, then it's just not all of your investments for those watching will be successful. It's just the nature of the game. Well, statistically speaking, someone out there will have some kind of freak luck and bet it all on Tesla. I don't think that's freak luck. Anyway, so that's my that's kind of my take on it. I think we're at an hour, a little bit over. Tyler, well, Jared, do you have any other? Well, Jared, could you close us out and get some final words from Tyler so we can share this incredible interview with the world?
Yeah, I mean, I think we had a great conversation on Opendoor and just really highlighted the power of its platform, its marketplace. But yeah, I mean, Tyler, any other closing thoughts?
I mean, yeah, thanks. Thank you guys for having me. Opendoor is reporting, let's see, in 3 weeks. Yeah, we got 3 weeks between now and Q4 earnings plus guidance for the entire year. So I'm definitely going to be there. I'm excited about it. I truly think that this is a generational company in the making. I think it definitely satisfies one of those companies that you're talking about that are just going to outperform for a prolonged period of time. And I think that the cushion of safety at this point is quite dramatic at its current valuation, especially with how rapidly it's growing. I think that's a manifestation of how misunderstood it is and how discounted it's been. But at the end of the day, like, we are, in my opinion, at this very early inflection point on a vertical slope of product adoption, and people realize that it doesn't have to be like that. It doesn't have to be like it's 1930. It doesn't have to feel so stressful and so painful to transact your home, to be a homeowner. And that's what Opendoor is solving for at the end of the day. That's why NPS is greater than 80. That's why 9 out of 10 customers recommend. And I think the culture, the vision, and the management are all in place for Opendoor, like I said, to outperform for a long period of time.
Yeah, I think that's a great way to put it. And, you know, it's just Keith or Boy's belief that if you add a frictionless, convenient, simple process to the home buying process, more people will sell their homes and want to buy homes, and it'll empower the whole flywheel marketplace. So, I mean, really enjoyed having you on the podcast. If there's anything else anywhere we could, people could find your work on Opendoor or other places, feel free to share.
Yeah, I write a newsletter called The Operator. It's a Substack free newsletter. You can find me on Twitter, Tyler Oakland. I should be the only one. I'm also on Seeking Alpha. But like I said, thanks so much, guys, for having me. We got to talk SoFi next time.
Yes, definitely. Got to do that. Got to talk SoFi, Galileo, and Marqeta. But great talk on Opendoor. Really appreciate it.
Thank you.
See you, Tyler.
See you guys.